All right, stock fans, this is MDB, and I'm coming at you with a second video. This is a special, and I just want to talk real quick about something which I saw that's not chart related, but here is the S&P 500, and you can see here, which I just talked about in the other video, we have a new Darvas box range, and at the moment, the market looks like it's going to the top of the range, but we don't know. Maybe the next weeks to come, things will turn and it'll go down to the bottom of the range. Here's why I'm doing a video and why I think it pays to be cautious. So this is the latest S&P 500 estimate numbers, and I downloaded them, and it's the latest numbers as of August 31, just a couple days ago. So we've gotten new estimates, and the way to look at this is the current price. Well, that's actually not the current price. Let's update it. 45.1577. 45.1577. The index here is 98% reported. So for all intents and purposes, this quarter is in the bag. We've got the index price, and then we've got the estimates right here. And then this is the percentage rates from this quarter versus the prior quarter. And then the PEs right here, trailing PE and forward PE. So from the latest estimates we see right here, they went up a little bit. The near one went down 2%, but overall estimates went up, estimates went up 0.30%. Okay, that's good. We always want them to go up more because that helps stocks go up. But here's the reason to be cautious. It's my belief markets look forward 6 months, and so right now it's looking at this as 33% growth. So right now markets are excited, and it shows. PEs are in what I consider to be a strong market level. PEs of between 20 and 24. And that jobs right here with the trailing PE and the forward PE. Things are priced bullish, but not so crazy that it's considered a bubble or anything like that. Just strong market, strong bull. Here's the problem that's coming up, in my opinion. So these future quarters, this is what's being estimated at the moment. You know, it's a little hard to estimate what's happening in 2024, but the analysts have to do their best guesses. And, you know, they go off what companies' guidance is, et cetera, et cetera. How they do that, I don't know. But these are the numbers that get put out, and I believe them wholeheartedly. These numbers do change. They change quite frequently. But here's the problem. So right now the market is currently we're in a strong market environment where the market sees 33% growth. Now, a smart person would say, well, wait a minute, MDB. These numbers are definitely lower than what we've got now. That's correct. So, see, this is how the market really looks at things. Instead of looking forward like that, they don't look at that. Instead, they tend to look at, let's change it to black. This is how the market really works. Right now, it's saying we've got strong growth. We're reasonably priced for that strong growth. And we're just not worried about what's coming because it's a crapshoot, nobody knows, etc. Well, what's going to happen on October 1st? This is what's going to happen. No fill, and we'll change this back to automatic. Oh, no to green. All of a sudden, it's going to go from 33% growth to 9% growth. That is the equivalent of slamming on the brakes. You know, it's like almost like somebody cuts you off in traffic when you're driving, and you got to hit the brakes and hope that there's not an accident. This is what's going to happen. All of a sudden, growth expectations are going to be ratcheted down. The market's going to be shocked. My God, there's less growth? We better sell some stuff. Because 2022 PEs, where you're only getting 9% growth, in my opinion, that's an overvalued situation. And so what will happen, in my opinion, let's cut the S&P 500 down to 4,000. Well, price, if the growth stays at a 9% forecast, then the only way to make the S&P 500 cheaper to reflect that growth is for price to go down and make the index more of a reasonable value. Now we know from history that an 8 is roughly the Great Depression, an 8 PE, and we're nowhere near that type of thing. A weak market is 12 to 16, okay? I definitely think the American economy is more dynamic. We don't really deserve a weak market, although we've got terrible political leadership and interest rates have gone higher and higher. What I think we're going to be in store for is a ratcheting down into just an average market where the PE is between 16 and 20. At S&P 500 4,000, 17 to 19, that meets the parameter of average market. An average market to match average growth. So is this going to resolve upwards into a new bull market? I don't know. Is it going to drop downwards to 4,000? That's a possibility, but I don't know. The key thing is timing. When is this all going to potentially take effect? Well, the new quarter, let's back this up. Currently, this new quarter that we're in is going to end on September 30th, right here. So the new lower growth number, which is going to show up, that's going to start on October 1st, because all this stuff will be shifted downwards and we'll get the new quarter. And this is what it's going to look like. And basically in my opinion, every investment manager on the planet is going to look at that and go, oh my God, and freak out. And they'll just have to adjust expectations, adjust portfolios, and ratchet things down to a more reasonable level. So my message here is one of caution. We have a Darvas box here to let us know that we're in a sideways range, and we'll just monitor this. Are we going to move up into a new bull, or are we going to maybe adjust to what I think is going to happen? A little slower growth. Maybe we'll just go sideways and endure that for another couple of quarters. That's the thing we don't know, so we got to pay attention to what the bars are doing and react appropriately when things happen. So that's some new extra information I wanted to share with you guys, and we will see what happens. Hope you enjoyed this. Talk to you soon. Bye.